Hello guys, welcome to our YouTube channel. My name is Tabiso Rantsiye. Guys, you must remember we are here to study. Today you're going to learn with stabza or trokeleza les stabza. Away. We are going to talk about different transactions and ledger account of companies. In our previous video, we spoke about introduction and basic concept regarding companies such as memorandum of incorporation, shares and shareholders, directors, and then the ability to enter into contract as a company. So today's main lesson is all about different transactions and ledger accounts of companies. Today's study outcomes are as follows. After engaging in this study unit, you will be able to differentiate different transactions unique to companies, record different transactions to ledger accounts of companies, calculate different amount using different method. Okay guys, today our first ledger account, it will be ordinary share capital. What is ordinary share capital? Ordinary share capital is a capital account whereby we show our incomes and expenses. Why it is regarded as a capital account? Guys, before we start our company, we must have a capital account whereby we show how much money are we going to start our company. That's where we involve investors in our company. Whenever investors invest in our company, we are going to have what? A capital account. It's a ledger account. So ordinary share capital, guys, it's what? It's a capital account. And it is classified under owner's equity when it comes to our accounting equation. Ordinary share capital, as it is classified under owner's equity. Owner's equity on the credit side increases. On the debit side decreases. So we have inflows and outflows of money. Whenever an investor comes in our company and decides to invest, our capital account, it will increase. Whenever as a business we decide to buy back our shares, our capital account, it will decrease. So we are going to talk about inflows and outflows of money in our company. But by using what? By using ordinary share capital. So the main aim of today's lesson is about what? Ordinary share capital. On our credit side, we have incomes which increases, and then we have as inflow of money. And then on our debit side, we have expenses, they decrease, outflow of money. Same as ordinary share capital. Whenever we issue out our shares, our capital, our ordinary share capital, it will increase. Whenever we decide to buy back our shares, our ordinary share capital, it will decrease. Okay, right, guys. As we have said, today we are going to talk about different transactions regarding companies. So now, first of all, we have the first step. We are going to use only 4 steps in this ledger account, which is ordinary share capital. The first step you must always know is that your opening balance. You can't open your account without having what? Your opening balance. How much money do we have as a company before we start issuing out our shares, before we decide to buy back our shares? So the first step, guys, whenever you get to your exam, whenever you get to class, you must think about the first step. Your first step is what? Your opening balances. And then you will have your T account, which is your ledger account. You have date, details, amount, date, and then details, amount on the credit side. And then what you must bear in mind, your dates, guys. Dates are very important when it comes to accounting, especially when preparing your ledger accounts of companies. So on the 1st of January, our financial year starts on the 1st of January, meaning it's 12 months period. It will end on 28th of December. From January till December is 12 months period. It's our financial year. So at the beginning, before you open your account, you must make sure you have your opening balance. Okay, they will give you a transaction. For example, they will say on the 1st of January 2020, John Ltd had the following balance in their ledger account. Like it's given already, like it's given. It's how much? 3,150,000. You just take that 3,150,000, you will record it on your credit side of ordinary share capital. That's all you must do. You just take it because it's given. But sometimes accounting is too tricky, so they will confuse you. Like maybe they will give you different transactions, such as, for example, on the 1st of January 2020, the business has an authorized share capital of 6 million shares. And then they say 70% of shares were in issue on the 1st January 2020 at 70 cents per share. Meaning you must calculate. They gave you your authorized shares, which is 6,000. Authorized shares are those shares we put in place before we open our company. How many shares do we have before we start issuing out shares, before we buy back shares? That's why we say it's authorized shares, meaning it's on the market. So now they say 70% of shares were in issue on the 1st January 2020 at 75 cents. So you're going to take your authorized shares, which is 6 million, multiply by 70%. We are only looking for that 70%. 6 million shares is our 100%, but we are only issuing 70% as our opening balance. So you're going to take your 6,000 million, multiply by 70%, and then you're going to get 4,200,000. That 4,200,000, it's your what? It's your unit of shares. We are prepared to issue this amount of shares at the beginning of the day, and then we multiply it by our 75 cents. And then we go to our credit side. As I have said that our credit side, our ordinary share capital increases. Our debit side, our ordinary share capital decreases. Or they will say on the 1st January 2020, 4,200,000 shares were issued at 75 cents. Like it's straightforward. You only need to calculate. You take your units of shares, multiply by your whatever price they are issuing, and then you have your opening balance. So the first step you must know, guys, it's your opening balance. You cannot prepare a ledger account without having your opening balance. Sometimes it's given, sometimes you must calculate it. So you must hold on that, guys. Make sure you hold on that. You must have your opening balance as our first step. It's our ledger account. Okay. Now we have our second step. First step, it's an inflow of money, opening balance. And now we have our second step, an inflow of money again in the market. Now the business is doing well. Okay, we issued our 4,200,000 shares in the market. Now we decide to issue more further because of the market is doing well, guys. They give you a transaction like this. For example, the business decided to issue more 50,000 units of shares to the public for 2 rand per share. They issued out a prospectus to the public that no, you are allowed to come and buy shares from our company. We are issue, meaning that whenever the business issue money issue shares to the public, the business will generate income. That's why we say it's an inflow of money in the business. Okay, guys, it's an inflow of money in our company. So we are going to take our 50,000 units of shares, multiply by 2 rand per share. How much are we going to earn from selling our shares as a company? We are going to get 100,000, and it will be recorded as what? Your date. First of all, your date. On which date? On the 1st of March. You're going to write 1st March 2020 we issued out shares as what? As bank, CRJ, cash receipt journal. Whenever we sell, like for example, guys, as a business owner, whenever you sell shoes, you sell t-shirts, you're going to generate money. So that money you're going to receive, it will be regarded as what? As cash receipt journal. We have that certain journal whereby we record all the inflows of money and outflows of money. So you're gonna say bank under your details, CRJ, which is cash receipt journal, and then you show your calculation, 50,000 unit shares multiplied by 2 rand per share, and then your amount is going to be 100,000. 100,000, it's an inflow of money in our company. We issued out shares, guys. Still remember, in our previous video we spoke about issue price. Whenever we issue shares, we issue our shares using what? Our issue price. We record on the credit side of our ordinary share capital. We are generating more income in our company. So simple. Remember, first step, opening balance. You can never start your ledger account without your opening balance. Second step, the inflow of money. We issue out. It depends how well we are doing. Sometimes you may buy back shares before you issue out shares. But for now, just to make it so simple and easy, step 2, we are issuing out shares to the public. We are generating money. It's an inflow of money in the company. Okay, and then guys, look, there's this thing whereby we call it's a double entry principle when it comes to accounting equation. Accounting equation, it's very, very important, guys. You must know it. You must know your assets are equals to owner's equity plus liability. So we have this thing called what? Double entry principle, whereby we say one account is credited, the other account is debited. One account is debited, the other account is credited. Double entry principle. So now I have showed you my double entry principle. Whenever we issue out shares to public, it's what for us? It's an income. But it's an income. So we have our bank ledger account. In our bank ledger account, we are going to do the same thing, that okay, whenever we receive money, our money goes to the bank, so our bank will increase. Bank is classified as an asset in the business. Bank is an asset, increases on the debit side, decreases on the credit side. But it's different when it comes to ordinary share capital or capital. Capital is an owner's equity. Owner's equity increases on the credit side, decreases on the debit side. Bank asset increase on the debit, decrease on the credit. So whenever we receive money, our bank will increase on the debit side. That's what is a double entry principles. There you can see we have our 100,000 on our debit side, detailed as ordinary share capital, and then our ordinary share capital, it will be bank. It's a double entry principle. Step 2, it's an issue of shares to the public. You will receive money. It's an inflow of money. I hope you understand. Okay guys, and then we have the outflow of money. We spoke about the inflow of money. Whenever we issue out, we receive money as a company. But now we are talking about outflow of money. Outflow of money, taking out your money in your bank account to buy something. Like you are taking out your money, you are spending your money on something else. It's an outflow of money. Okay, and then now the outflow of money in our ordinary share capital, it will be the buyback of shares or repurchase of shares by a business or by a company. You may be given a transaction. For example, 60,000 ordinary shares were repurchased. Because of that weight, guys, you must know those weight were repurchased. 6,000 ordinary shares were bought back. Like you must know, you must differentiate issue price and buyback. Issue price, repurchase. So you must like understand those terms. Now we are repurchasing our shares. We are taking money out of the company to buy shares from another shareholder. It says 60,000 ordinary shares were repurchased from a shareholder on the 1st June 2020. The company paid R350 per share. Here's the thing, guys. There's a huge difference when it comes to this part. You must like listen carefully and understand. Whenever you come towards repurchase or buyback of shares, you must think about average price. We do not sell with a market price, but we only sell using what? Our average price. Okay, let me show you. For example, guys, we have our ordinary share capital at the beginning of the year, 1st January 2020. Our first step, our opening balance, which is balance brought down. That B and slash and D, it's our balance brought down. That balance, we are starting it on our new financial year. So we will have amount of 3,150,000, and then the 1st of March we issued out our prospectus. We are selling our shares. We receive money. We receive how much? 100,000 as our step 2. Now our step 3, which is we are taking money from our company. It's an outflow of money. We decided to repurchase shares from our shareholder. It will be recorded on our credit side, which is on the 1st June 2020, bank CPJ. You see, there's a difference between CPJ and CRJ. CPJ, cash payment journal. We are paying, we are spending. Cash payment journal. CRJ, cash receipt journal. Cash receipt journal on the credit side, cash payment journal on the debit side. You won't struggle here, guys. Okay, here I was talking about, guys, whenever we issue out shares, we must find our average price. You must think of your average price. Okay, at the beginning of the year, we had 4,200,000 shares in issue at the beginning of the year. Those are our units of shares. And then we decided to do what? To issue more 50,000 shares. So you're gonna say, so you're going to say your 4,200,000 units of shares plus your 50,000 issued shares equals to 4,250,000 shares. And then you will say your opening balance plus your issue amount of shares, which it will be 3,150,000 plus 100,000 equals to 3,250 million. 3,250 million divided by your units of shares, which is 4,200,000 plus your 50,000 issued shares. It's an average price. Amount divided by units of shares. You are going to get your average price. Your average price, it will be 76 cents. So we are going to use that 76 cents as our average price rather than using our 350. It's different from issuing of shares. We are repurchasing. So you're gonna say your amount of shares divided by units of shares. You're gonna get your average price, and then you take that average price, multiply by that 60 units of shares that we are repurchasing from our shareholder, and then you're gonna get how much? 45,600 at the end of the day. You're going to take out 45,600 on the bank account of the business. Outflow of money. Okay, average price always, guys. Amount at the beginning, amount of shares on the top, and then divided by units of shares. Opening, step 1 plus step 2. Only use step 1 and step 2. If we don't have step 2, you just only use step 1 just to calculate average price. And then there will be a question: why don't we use 350 instead of 76 cents? That's a nice question, guys. Okay, look, after having our average price, we are going to take our market price, subtract it with our average price, and then we are going to get how much? 2.74 cents. That 2.74 cents, we are going to use it when we open our retained income. That's the amount of money we retained from repurchasing of shares. Okay, but on that part, we will get it on our day 3. For now, you must focus on ordinary share capital, your inflows, opening balance and issuing of shares, and then your outflow, repurchase of shares, and then you are done with ordinary share capital. And then you will have your T account, your complete T account. On the 1st, you have your amount with issued shares on the 1st of March, which is 100,000, and then we decided to repurchase shares On the 1st of June 2020, we have our bank CPJ. The money goes out from the business. We have how much? 45,600. Now we are done with our steps. The last step is closing off. Our last step is closing off. Balance on the 28th December 2020 at the end of our financial year, guys. We started with how much? With 3,150,000. But now our closing amount, after issuing out shares, after repurchasing of shares, how much are we left with in our company? So you're gonna say you must balance your equation. Whatever happens on your credit side, it must happen on your debit side. If you have 500 in your debit side, you must also have 500 on your credit side. We balance the equation. Okay, guys, you're gonna say your 3,150,000 plus your 100,000 equals to 3,250,000. That 3,250,000, it must appear on your debit side as 3,250,000. So you're gonna say your opening balance plus your issue of shares subtract your repurchase. Inflows subtract outflows. Inflows subtract your outflows, and then you're gonna get that difference. That difference is our balance carried down. We carry it down because of it's our difference, and then we're still taking it to the next financial year as our opening balance. Here it's our closing balance. It's how much? 3,204,400. It's our closing amount. Our next financial year, we are going to carry this amount and open our books, our ledger account, using this same amount. And then again, we're gonna repeat the same thing. We're gonna issue out shares, we're gonna repurchase and close off and still carry to the next financial year. That's how the company works. I hope you understand, guys. And then, guys, the most important, like when it comes to grade 12, as I have said, you must be related to grade 10 and grade 11 work. Grade 10 and grade 11, we deal with ledger accounts only. But when it comes to grade 12, we deal with notes so that we can be able to record in our financial statement, such as balance sheet. So mainly our ordinary share capital will be recorded in our balance sheet as owner's equity. It will be ordinary share capital, but in order to record in our balance sheet, we must have our note, guys. So we start learning from ledger account so that we can be able to complete our note. So ordinary share capital is regarded as note number 7, guys. This note is very easy. You have your ledger account. In your ledger account, you have your opening balance. You just write the opening balance. You have your authorized share capital of 6 million shares, and then you will have your balance at the beginning, your opening balance, which you have already recorded it as 3,150,000, and then on that side you show the shares 4,200,000, and then we issue out shares, and then we repurchase, and then we close off. We just go straight. It's a straightforward procedure. That's why we say it's a note. Balance at the end will be recorded to the balance sheet under owner's equity as ordinary share capital. After that 3,204,400, you're going to record it on your balance sheet as it is. As it is. I hope you understand, guys. Whenever you have any questions to ask, you can comment, or you can use my social media platform, follow my links, and then I will get back to you guys. So today's lesson will end here. You may rewind and start again and listen again. We are done with ordinary share capital. Our next session, we are going to discuss retained income account and the note to the balance sheet. And then I will explain about that R2.74. What will happen with that amount? It will go to our retained income. So our day 3, we are going to talk about retained income, and then we do the note, and then we are done. You may enjoy your day. make sure you have your notes and you are ready to start. Sheba, banales tabalaza. Sharp, sharp.